Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Today, we're talking about the DoD. No, not the Department of Defense, but the dogs of the Dow, the 2020 version, on the College Investor Audio Show. Thanks so much for being with us. So, the 2019 dogs of the Dow, or DoD, returned 18.49%. Their 2019 yield was 3.90%. You can see the whole 2020 DoD lineup in a graph at thecollegeinvestor.com, and you can see all of the different dividend yields there too. Now, the yield, or I should say year-to-date, or YTD yield, is 4.79%. As you'd probably guess, the dogs are down YTD, like most everything else. Their current percentage change is 16.2%. And by contrast, the Dow is down 9.2% YTD. So now let's take a look at how you can invest in the dogs of the Dow. Keep in mind that DD is an income strategy, a dividend paying, rather than growth strategy. So be sure that your investment objectives align before investing in DD. Now, since every DD is a stock, you can begin investing in them by purchasing shares through any brokerage. DD is meant to be a buy and hold strategy. In other words, if any of your DD holdings begin going down, you don't sell them. You can decide if you want your 10 DD to be equal by dollar weight. So dollar weighing means that you own the same dollar amount in each DD stock. For example, you allocate $10,000 to each DD, resulting in a $100,000 DD portfolio. As DD stocks move up and down, you can reallocate to bring things back into alignment. So say ExxonMobil or XOM might at some point be worth $15,000, while Pfizer is worth $5,000. So to reallocate, you sell $5,000 of XOM and buy $5,000 of Pfizer. This might be done once each quarter or twice a year, maybe just once a year. So dogs of the Dow ETFs. No, there aren't any. There aren't any ETFs that are 100% exposed to the dogs of the Dow. Most have an equity and bond mix exposure. This mixture likely exists to offset market declines. So here are 3 funds that offer dogs of the Dow exposure. Hennessy Balanced Fund. It's HBFBX. Large Cap Value Fund. 50% of assets in the dogs of the Dow and U.S. Treasury securities with a maturity of less than 1 year. The expense ratio is 1.89%. Hennessy Total Return, HDOGX. 75% in the dogs and 25% in U.S. Treasury securities with a maturity of less than 1 year. The expense ratio, 2.32%. ALPS, or ALPS, Sector Dividend Dogs ETF, SDOG, seeks to replicate the S-Network Sector Dividend Dogs Index. The expense ratio is 0.40%. A quick one today, but I hope that gives just a little bit of an insight on the 2020 dogs of the Dow and how to invest in them if you choose to do so. If you want to find out more about this, you can see an amazing article. Just search for 2020 Dogs of the Dow at thecollegeinvestor.com. You can see charts and graphs too and all kinds of cool stuff. Again, thecollegeinvestor.com. Thanks again for listening today, and we'll talk to you again very soon.